Well, greetings everyone, coming to you from the Sugarloaf in Market Harborough, where James and I have been out meeting a few clients, and we've stopped for refreshment. That's coffee before you get any ideas. And we're back together to join you in another episode where James will cover some financial matters that may be of interest to you. So, hello James, and thank you for joining me.
Hi Anthony, hi Internet.
Okay, well, this has been an interesting week because we've had competition back in the mortgage interest rates market, with HSBC introducing a fixed mortgage for 5 years at 3.99%, and I believe that one or two others also entered the market slightly lower at 3.75%. Now, whilst that's good news, it could, for those of you with a cynical mindset, be interpreted as quite alarming, because for banks to be introducing fixed rate mortgages below the current base rate, it does demonstrate that the degree of borrowing over the last few months has collapsed and they're desperate to lend their money. Whilst nobody's put it in these terms, just to convey the significance of what's actually happened, the base rate this time last year was 0.1%. It is now 4%, as you know. In percentage terms, it's actually quite horrifying, because over the last year the base rate has risen by 4,000%. If that were a loan, it would be considered to be loan sharking. So, James, what's your take on this, and what advice would you have for people in the market for a mortgage at this moment in time?
Yeah, thanks Anthony. So it is for a lot of people, quite a scary time, and what we're hearing is a lot of clients are talking about, do I hold back, do I wait, is it prudent to give it some time before things start to settle down? And I think people are waiting for things to return to post-2008 territory in terms of base rate and interest rate. And the scary thing about that is, I think that where we're at now is possibly going to be the new normal for quite some time to come. No one knows how long entirely. If we go for the HSBC mortgages that they're offering, just tying in for 5 years, what's going to be happening over the next 5 years? If you're going into a loan of that magnitude for that long, my heartfelt advice would be to reach out and find somebody, get some advice, get more than one person's advice, go and talk to a few people and find out exactly what your mortgage rate is at the moment, how much you've got left on your term. It's coming up this year. Have a conversation with somebody who's qualified. You can look at possibly what your vacation charges might be to come out of that mortgage early. They often can be quite surprising. Is it going to be the best thing to go for a remortgage with a different provider? Would it be better to go for an advance with your current provider? So the base for me is always have a conversation with somebody who is in the profession, who can navigate you and show you which way to go in terms of moving forward. It's the best thing to do.
Obviously, in the few decades preceding the 2008 crash, which was a almost once in a lifetime freak event in the terms of how it all panned out, the average interest rate was between 6 or 8%. But for those of you who are younger, much younger than I, you've literally spent your adult lives with a base rate of 0.5% for the main part. And I know from people who are younger around me, up until last year, they were adamant that rates wouldn't go up too much, absolutely adamant. And even up until a few months ago, if you actually search through social media, you'll find people who were actually in the industry who were also saying rates could not go up this much. What we need to bear in mind is that 0.5% was not the norm, it was a freak low. And although anything is possible, as we know, the odds of rates falling below 2% again are very, very, very slim. And as we can see from the inflation figures, which is stubbornly refusing to fall, regardless of the fact that they may have the best of intentions to reduce interest rates as soon as possible, the pressure is still for interest rates to go upwards. So definitely don't delay, don't sit there hoping that if you wait a few months you're going to find a fixed rate at 2%, because you might not, because the pressure is upwards only. What do you think about that, James?
Yeah, I think the big thing that's being peddled at the moment, what we're seeing a lot online, is fear. It's essentially, there's a lot of clickbait in terms of the housing market is crashing, gosh, what do. And so I just want to speak sort of into that a little bit really and say, please don't worry, there are options available. If the new normal is this level of percentage in terms of what you're going to be paying your interest rate, it can be used to people's advantage, and it's a case of having open conversations and finding out what's on the table, what's available to you. There are options, there will be an option, whether it's looking at tracker rate mortgages. The banks, lenders will always bring out products that are going to be viable in the current circumstances. So I guess my heartbeat is not to be afraid and not to worry and not to make impulse decisions, or indeed hold back longer than you think is normally necessary, because we're scared of what might happen and waiting for it to change. It really is about getting into dialogue with an advisor, with a consultant who can show you all the options on the table. I would just say, go to more than one person. A good consultant, a good financial consultant, a good mortgage broker will guide you and educate you on the options, not just sell you a product, not just show you one way to go, but put a plethora of options on the table and guide you and educate you in that this is why X fits this particular scenario, and this is why Y could be competitive to that. So yeah, if you're not getting that service, if you're not getting that advice, go and ask somebody else. See more than one, see more than 5 if necessary. They should be giving you the answers of how to do it yourself, essentially.
So if there are people out there who really they're in a quandary, they don't know what to do for the best, and they're sat there worrying, and they're thinking, well, I don't know whether I should contact a financial advisor because I don't want to waste their time, because I don't know what I'm doing, I don't want to incur any costs because they're going to charge me, aren't they, for giving me some advice. What would you say to them?
Yeah, I would say costs are inevitable when we do absolutely nothing, and a good consultant will have a no obligation conversation with you at length for no cost whatsoever. We do that here, so by all means, give us an email, give us a call. We'd be happy to talk with you at length. But if there are other people in your locality or within your networks that you know, reach out, have that conversation. They should not be charging whatsoever, and should be giving you a good steer. Because essentially, it's relationship, it's built on reputation. A good advisor will know that they look after you, they'll be able to look after you throughout the course of your progressive lifetime, through children and grandchildren and so on and so forth. So yeah, find somebody that's worth their salt, have that honest conversation with you, and be very open and transparent about what their view of the market is and where you fit within that. That's what we need to be looking for.
Absolutely wonderful. Well, I think time's up for this particular video. Thank you very, very much, James. I will add James's contact details in the description or somewhere if you'd like to get in touch with him, and we'll see you in the next video.